Hello and welcome back to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximise your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. In today's video, I'll be breaking down my InvestEngine portfolio performance over the past month, what went up, what went down, and any changes I've made, and my thoughts going forward. There is going to be one big change that I'm making, so you'll want to stay tuned for that. Whether you're a long-term investor or just getting started with InvestEngine, this should give you some insight into how a diversified ETF portfolio behaves over time. My portfolio is currently split between my ISA account and my general investing account. The reason for this is that up until last year, you could only hold one ISA at a time, and that ISA that I held was over on my main account on Trading 212. However, since April 2024, the rules did change and now you can open multiple ISA accounts. The only condition is that across them all, you can't exceed the annual £20,000 contribution limit. Since that change came into effect, I've been consistently adding £100 into my ISA, Factor, ETF and Chill Pie, and as you can see, it's already up to £1,900, and in today's video, I will be adding my next £100 as I do every single month, so make sure you stay tuned for that and see the stocks that I'll be buying. And if we zoom out and look at the overall portfolio value, we can see that it's edging closer to that £3,000 mark. What makes this portfolio unique is that every ETF I hold is a factor ETF. For anyone new to the concept, a factor ETF is an exchange-traded fund designed to target specific investment characteristics or factors that research has shown can lead to stronger returns or lower risk over the long run. Some of the most common factors include value, which are stocks that are cheap compared to their earnings or assets; growth, which is companies growing faster than the market average; momentum, that's stocks that have recently performed strongly; quality, which is companies with solid balance sheets and consistent profits; or low volatility, which is stocks that tend to be more stable and fluctuate less. So instead of simply tracking a broad market index, factor ETFs let you focus on strategies or styles of investing that align with your own personal goals. And in the portfolio I'm sharing with you today, I think I've built a strong blend of factors I want exposure to. Having said that, there is one position within the portfolio that I feel isn't adding too much value, and I'd rather consolidate my other positions, which is exactly what I'm going to do. Now, let's actually take a look at how these factors have performed in my portfolio for the month of September. Overall, last month was a really strong month, with the portfolio gaining 2.83%, and it was up over £50. This is now the 5th month in a row that the portfolio has been in the green, which is great to see. If I do compare my own portfolio against the S&P 500, we can see that the S&P 500 was actually up 3.11% in September, so it did have a slightly better performance when compared to my portfolio. But when we look closer at my own portfolio, we can see that actually 2 of my positions did outperform the S&P 500, and all of them were in the green for the month. My best performer this month was the X-Trackers MSCI World Momentum, stock ticker XDEM. This ETF tracks the MSCI World Momentum Index, which focuses on large and mid-cap companies around the globe that are showing strong momentum. For the month, it was up 4.9%, so a really good gain, and the top 3 holdings within this one are Broadcom at 5.7%, you've got Palantir at 3.6%, and then you've got the JP Morgan Chase & Co Bank at 3.3%. What really stands out with this one is the sector breakdown. If we have a closer look, we can see that between industrials and financials, it actually makes up nearly half of the portfolio at 47.6%. And it is then closely followed by technology, which is 18.6% of the portfolio. As you can see in the portfolio, this one makes up around 15% of my overall portfolio, the same allocation as a couple of my other funds. And momentum investing is all about chasing stocks with strong recent performance trends. From my experience, when the overall market is moving up, this fund can capture some really strong gains. But when the market dips, the volatility definitely increases. The next best performer for me in my portfolio was my biggest allocation in the portfolio at 30%, and that is the UBS Factor MSCI USA Quality ESG ETF, stock ticker UC99. This one was the only ETF that was down last month and has recovered really well, being up over 4%. The goal of this fund is to give investors exposure to high quality US companies that also meet environmental, social and governance standards. It tracks the MSCI USA Quality ESG Low Carbon Select Index, which is quite a mouthful, and this looks for companies with strong fundamentals while also keeping an eye on sustainability. The top 3 holdings within this one are all big tech names, with them being Nvidia at a massive 9.9%, followed by Apple at 8.6%, and then you've got Microsoft at 8.5%. Now here's something interesting about this one. The sector breakdown has shifted quite a bit recently. Industrials is now the biggest in the portfolio, taking up 37.8% of the ETF, which is a huge jump considering technology used to be its biggest slice at over half the portfolio at 52%. Tech is now down to 28.8%, and then that is followed by financials at 8%. The reason I've made this my largest allocation is because of its strong track record since inception. It's delivered an average annualized rate of return of 18.09% including dividends, which actually means it's outperformed the S&P 500 over that time period. Of course, past performance does not guarantee future results, so as always, make sure to do your own research before considering it for your own portfolio. The third best performer this month was my other Xtrackers ETF, and that is the Xtrackers MSCI World Quality ETF, stock ticker XDEQ. This one was up exactly 3% for the month, and it tracks the MSCI World Selector Neutral Quality Index, which targets developed market companies with high quality fundamentals, things like strong returns on equity, steady earnings growth, and even low debt. The top 3 holdings within this one are actually Nvidia again at 6.3%. You've also got Apple in this one at 5.3% and Microsoft in there at 5.2%. You might notice that these top 3 are the exact same as the UBS Factor MSCI USA Quality ETF that I've just showed you, but the allocations in XDEQ are smaller and the overall mix of companies and sector breakdowns looks very different, so it still adds diversification to the portfolio. And I also want to add in here as well that if you pay close attention to my ETFs, you might notice that there is quite a bit of overlap. But honestly, I don't mind having stocks that overlap between my ETFs. In fact, I welcome it when the companies I consider are high quality that are overlapping. And if I'm doubling down on names like Microsoft, Nvidia or Apple, I'm more than happy to do so. When looking at the sector breakdown of this one, we can see industrial makes up 22.5%, you've got technology at 20.7%, and then financials at 17.7%. If this ETF sounds interesting to you, keep in mind its focus on high quality companies across developed markets, its sector and geographical diversification, and the fact that it uses an accumulate and dividend policy. But as always though, it's worth making sure it fits your own goal and risk tolerance. Next up, we have the S&P Small Cap 600, which was up 1.15% this month. This ETF has been on a bit of a rally lately, as a couple of months ago this was massively in the red, but now overall it's finally back up into the green, and I'm actually very optimistic about this one moving forward. This fund tracks the S&P Small Cap 600 Index, which is made up of 600 smaller US companies. This gives me the exposure to a corner of the US market that I probably wouldn't invest in directly myself. For September, like I said, it was up a steady 1.15%, and if we have a look at the top 3 holdings within this one, we have the BlackRock Liquidity Agency at 1.1%, Mr. Cooper Group at 1%, and then you had SanDisk Corp at 0.8%. So the top holdings within this one are vastly different compared to the other ETFs I have in my portfolio, which is exactly what I'm after. And in terms of the sector breakdown, we can see industrial sits at 29.2%. You've then got financials at 13.7%. And for the first time today, seeing property within the top 3 within an ETF, and it is at 7.5%. A quick note of caution here, small cap stocks are naturally more volatile and less liquid compared against large cap companies, so they can be quite a bit unpredictable. It's definitely worth keeping that in mind and making sure it fits your own personal risk tolerance. In my own portfolio, as you can see when I click back here, this one is another holding that's got a 15% allocation within the portfolio. And finally, we've got the Wisdom Tree Global Quality Dividend Growth ETF, stock ticker GGRG. This one makes up 25% of the overall portfolio and is up just under 1% over the last month. If you're wondering what the big change is for the portfolio this month, it's that I'm going to sell out of this entire position. The plan is to then redistribute the capital across my existing core holdings to strengthen my long-term positioning. Specifically, I'm going to increase the allocation to the UBS Factor MSCI USA Quality ESG ETF to 50% in the portfolio. And then I'm going to add a further 5% to XDEM and 5% to XDEQ, meanwhile trimming 5% off my ISP6 position to balance the weightings. One of the main reasons I've decided to sell out of this ETF is because I feel like it's not performing as well as I expected it to, and I just feel like having the majority of these funds within the UC99 ETF is going to yield better results over the longer term, as I want to lean further into a factor-based approach within the US market, as I believe it remains the most innovative and resilient economy over the long term. UC99 provides a rules-based methodology that captures quality, value and momentum factors, giving me a more disciplined way to target US companies with strong fundamentals and attractive risk-adjusted return potential. Increasing this allocation reflects my conviction in the structural strength of US equities and the long-term outperformance of factor investing. While I'm reducing the global growth exposure by selling GGRG, I still want to maintain diversified international exposure. By adding to my XDEQ and XDEM positions, I'm selectively increasing my stake in European quality companies and emerging markets growth, both of which provide complementary return drivers and reduce over-reliance on the US market. This approach allows me to keep a global footprint, but in a more factor-driven and deliberate way. GGRG offered broad global quality growth exposure, but I feel its role has become redundant now that my US and international factor allocations are more targeted. By consolidating into UC99, XDEQ and XDEM, I simplify the portfolio while maintaining the quality growth tilt, just with a more evidence-based, factor-driven framework. The slight reduction in ISP6 ensures my US exposure remains balanced after the larger UC99 increase. Overall, this reallocation strengthens my portfolio by deepening convictions in proven factors, enhancing geographic balance with more precise exposure, and removing an ETF whose mandate is now less essential to my long-term strategy. Having said that, I'm still really interested to know your thoughts on this move, so please let me know in the comment section down below. So without further ado, let's put in this month's £100 investment. It's very easy to do on InvestEngine. You just simply click on the portfolio, press the amount you want to add, and add it into the portfolio, review order, and then that will go through at 2:30 the following day. And there we have it, the portfolio has finally crossed the £2,000 mark. I've just realised that I've actually added that £100 across the entire portfolio when I was supposed to sell out of the GGRG position. Now that money's going in, what I'm going to do is wait for this to go through tomorrow, and then I will sell the entire position tomorrow and reallocate the rest of that capital into the rest of the portfolio at those new allocation sizes that I mentioned to you before. I really enjoy making this series because it shows how powerful consistency can be. By simply adding £100 every month, the portfolio keeps growing and it builds that healthy, long-term habit of investing. Remember, it doesn't matter if it's £100, £50 or even £10. Investing whatever you can each month makes a massive difference over time. Wealth isn't built by time in the market, it's built by time within the market. Patience and consistency are what turns small seeds into lasting wealth. That wraps up this month's InvestEngine Portfolio Update. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more monthly updates, dividend news and investing tips. Got any questions or want to share how your portfolio is doing? Drop a comment below. I read and reply to every single one. Thanks for watching, and as always, stay patient, stay consistent, and let your money work for you. Until next time, this is the Geordie Pig Investor, over and out.